When it comes to investing our money and paying off debt, we're given multiple options and things to choose from. TFSA, RRSP, do I pay my mortgage? Do I pay off student loans? We don't know what to choose and the best order to apply those payments. If you ask anyone, their opinion, it's like pizza places. Everyone knows the best place in town. They'll always have an opinion about it and what you should do. Given the cost of living and housing crisis that we're all going through, every dollar matters that much more to us. So we want to be sure that it's invested wisely, that we pay down what we need to pay down or off, and that we're taking advantage of all the proper tax benefits that we can. So here's the optimal order for investing your money and paying off debt. If you're new here, I'm Aaron, a 20-year corporate accountant and analyst living in Western Canada. I discuss personal finance and investing. Now let's get right into it. Number one, creating an emergency fund. This is without a doubt the absolute first and best thing you must do before you think of putting $1 into any investment account that's taxable. Create an emergency fund. I cannot stress that enough. I started an emergency fund at 42, 41. I was a late bloomer. I know, hand slap. I should have known better. But now that I have one, I sleep that much better at night. I had my car break down a few years ago and I needed cash quickly because I had to get to work. And I was very stressed out about it until I realized I had already started my emergency fund. I dipped into that. It wasn't much of an issue. And I was able to get to work. Think of an emergency fund like an inflatable tire. You're driving alongside the road, car breaks down. It's like an inflatable tire that automatically inflates. You're back on the road, smooth sailing. Now, financial advisors say you should have ideally 3 to 6 months of earned income set aside for your emergency fund. However, even 1 to 2 months or just continually donating something is well worth the effort. A recent Statistics Canada report found that 1 in 4 Canadians could not come up with $500 if they had to, if they were in a pinch. So if your car breaks down, you have repairs that have to be done on the house, you have a medical emergency, as no one ever plans for an emergency, and you'll need that cash quickly. An emergency fund is a great thing to have. Like I said, I sleep so much better at night knowing that I can quickly dip into that emergency fund if I need it. Ideally, you want to keep your emergency fund in a high yield savings account. 1, to combat inflation generated by the high interest earned in a high yield savings account. And 2, you're able to access that money quickly and easily so it's there when you need it. It's not tied up in some investment portfolio where you have to call, get access, you have a waiting period. You'll need that cash right away. Number 2, an RRSP employer matching program. What this is where your employer matches whatever you contribute to your RRSP. So if you contribute 3% of your gross income, your employer matches you 3%. So think of it this way. If you put $1,000 towards your RRSP and your employer matches you 100%, that's an extra $1,000 to your RRSP. Even 50% is like getting a 50% return on your investment, an extra $500 going with our example. There's not an investment in the world that would generate that kind of a return. Anytime an employer offers you and matches whatever you contribute, you should almost always max out on that contribution. Similar things offered by employers are group RRSPs and employer stock option plans. Like I said, this is free money, so you should take full advantage of it. These are often given as perks to employees to encourage performance and productivity. However, not every employer offers these kind of benefits, so check with your HR department to see what your RRSP matching program is. However, if you plan to maybe not be with that company very long, be sure to inquire about their vesting schedule. What a vesting schedule is it determines the length of time you have to be at that company in order to receive those benefits. Usually it's around 3 years, but it could vary depending upon the company. So be sure to check with your HR department. However, I'd advise bringing it up somewhat casually. You don't want to arouse suspicion like, what, are you planning on leaving us? Well, you never know. Number 3, high interest debt. We'll consider high interest debt anything above 5%. So this includes the normal culprits like credit cards. I consider credit cards one of the worst offenders, only superseded by payday loans in their interest rate. The average credit card runs from 16 to even 30%. So this is a huge chunk of your income that you're losing every month towards debt. So think of it like if you owe $1,000 in credit card debt and you don't pay that off, well, that's anywhere from $160 to $300 you're paying every year that you're losing. So you want to ideally pay that off. So for paying off debt, you can either apply the avalanche method, which tackles the one with the highest interest rate first, which makes mathematical financial sense, or the snowball method, which tackles the debt with the lowest balance. I myself, despite it being mathematically sound, like the snowball method. I like tackling the small debts first. You get them out of the way, and then you don't think about it again. Say it's a small credit card, you pay that off, you never use it again. That one's done, on to the next one. So that's, for me, what's worked in the past, but pick a method that works for you. And one thing to keep in mind is debt consolidation. Consolidation. Oh, frig. Whatever. You know what I'm trying to say. Debt consolidation. Frig, finally. So what this is taking all those credit cards and maybe moving them on to a line of credit that has a lower interest rate. That way your monthly payments are reduced and it's a debt that you can actually tackle and handle. Drum roll number 4. TFSA and FHSA. God, the acronyms just kill you, eh? So the TFSA allows you to contribute to it after tax has already been taken off. You invest that money. However, when you take it out, it is not taxed because it's previously already been subject to tax. It works in the reverse like an RRSP. An RRSP is not taxed, and then when you withdraw from it, it is taxed. In my mind, I see RRSPs to be used for long-term financial goals such as retirement. TFSAs are more for short-term goals because you can get at that money and you pay no tax. You're not subject to any tax penalty. However, it can be used for medium or long-term goals as well. The TFSA annual limit for 2024 and 2025 is $7,000, with any unused room being able to be carried forward indefinitely. TFSAs can hold a variety of investments, so stocks, EFTs, bonds, GICs. There's really a lot of options given to you, and you can also use it as a secondary emergency fund if you needed it.
The First Home Savings Account, an excellent tool for Canadians aiming to save for their first home. Launched in April 2023, the First Home Savings Account is a registered plan designed to help eligible individuals save for the purchase of their first property in Canada. Each year, you can contribute up to $8,000 with a lifetime contribution limit of $40,000. If you don't maximize, your annual contribution room can be carried forward, but only up to $8,000 in unused room per year. Contributions are tax deductible, much like an RRSP, and any investment growth within the account is tax-free, similar to a TFSA. This combination of tax benefits makes the FHSA a powerful savings vehicle. To qualify, you must be a Canadian resident, at least 18 years old, and a first-time homebuyer, which means you haven't owned a home in the current year or the previous 4 calendar years. Funds in the FHSA can be withdrawn tax-free, provided they're used for purchasing a qualifying home. However, if the funds are withdrawn for other purposes, the amount becomes taxable income. You have 15 years to use the funds, transfer them to another FHSA, or roll them into an RRSP or RIF account without tax consequences. The plan is flexible, but its primary focus is on homeownership. Other uses are not permitted without tax penalties.
For those of you new to my channel, welcome. I'm Aaron, a 20-year corporate accountant and analyst living in Western Canada. I talk about personal finance, investing, the downfall of Canada, and things that affect the middle and working class. I also am a big fan of the TV show Suits.
By the way, you gotta work under Stallone. You need a lower register. Ooh.
That was an incredible Stallone. I've been doing that since I was a kid. You can't touch it.
Ooh.
And Breaking Bad. So if you see little pop-ups or clips, hey, that's why. It is what it is. That's what I do. So if this all sounds like something you'd be interested in, consider subscribing to my channel. Number 5, an RESP, a Registered Education Savings Plan, a post-secondary account set up for your children in case they ever go to college or university to help out with their tuition. An RESP provides tax shelter growth and government incentives to save for your child's post-secondary education. The CESG offers a 20% match on annual contributions up to $2,500, providing up to $500 annually and $7,200 lifetime per child. Investment growth in the RESP is tax deferred, and withdrawals are taxed in the child's lower income tax bracket. The contribution strategy here is to start early to maximize growth and to take advantage of compound interest. Prioritize this if you have children. However, if you don't want to and want them to fend for themselves, don't open one. They can figure it out. I'm a parent of 2 children myself, a boy and a girl, twins, and we opened one years ago, and I think it's one of the best things you can do for your children. Given this day and age with the soaring cost of tuition and housing prices, we got to help them out whenever we can, right? We all want our children to succeed. Number 6, maximizing RRSP contributions, using up that excess room that we've carried forward or have for the year. We want to take advantage of any remaining unused contribution room that we have towards our RRSP and any carry forward that we can use. When we contribute to our RRSP, we are contributing before it's been subject to any tax. That allows for a greater return on our investment. So we want to take full advantage as much as we can to ensure we generate the highest return possible. So before you think of putting any money into a taxable account, make sure you max out your RRSP contributions before you buy anything else. The only exception to this would be, say you see the complete collection of the Breaking Bad series on sale, right? Well, then you gotta buy it, right? So it's on sale, why not? You only live once. So when we contribute to our RRSP, ideally it's in these younger years, right? So it knocks us from a high income tax bracket into a lower income tax bracket. Then when we withdraw from our RRSP, which is considered taxable income, hopefully, ideally, we're in a lower income tax bracket, so we're subject to a lower marginal tax rate. Number 7, what you've all been waiting for, investing. This is where you can actually start looking into investing in taxable accounts once all of your registered accounts have been completely maxed out. This is where you want to start looking at stocks, ETFs, mutual funds, GICs, even cryptocurrency. All of these you want to consider, start investing and make it part of your portfolio. Focus on tax efficient options such as dividends or capital gains. Diversification. Use taxable accounts to maintain a balanced portfolio spread over a variety of accounts and asset classes. Number 8, paying off low interest debt. So this is where lines of credit, student loans come into play. We want to reduce our financial obligations and increase our cash flow. Interest rates below 7% are generally manageable compared to potential investment returns. Focus on minimum payments while directing excessive funds to higher yield investments or higher interest debts first. Again, if you're having trouble with this, look into debt consolidation. Number 9, paying off your mortgage or putting as much towards your mortgage as you possibly can. The thought of being mortgage free, right? You bought your house, you paid it off completely. As long as you pay your property tax, you don't have to answer to anybody. I think that's everyone's dream. Now, I put this last on my list. However, I'm not going to argue with someone who wants to bump this up to number 8 or even number 7. Some people say you should pay off your mortgage first. Other people say, oh, you should invest that in the stock market. You'll generate a higher return on average. There's pros and cons to each of these. So there's no right or wrong answer. I can see the benefits for both of these. I almost bumped this one up higher because there's just something so great about owning your house. So I have a little bit more debt here and there. I own my house. So if something happens and interest rates rise astronomically or whatever, I always will own my home. There's something to be said about that. So I'm not discounting that. So this is my list. Leave me a comment with if you agree with it, if you think I should have ranked things a little bit differently, thoughts on the video, whatever you want to say. I'd love to hear from you. So if you're one of those people that maybe thinks it's too late to buy Bitcoin, right? Or don't even know how to start buying Bitcoin and you're interested, click this video on the left. For those of you still interested in tax and want to learn about important tax changes for 2025 in Canada, you'll want to click this next video here on the right.